Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss what really matters to the market and economy for the remainder of November, as Phil and I will be taking some time off from the daily econ show, and we'll be back December 1st. And Phil, let's start off where we were and where we are now when it comes to volatility relative to the election. Earnings season was in between there. We had some vaccination news, of course.
Yeah, I mean, in reality, the last 2 weeks has been full of really important news that we've been waiting on for a long time. So the election is pretty much mostly resolved. And the fact that we have two good vaccine solutions now and a couple of other vaccines with good news in their phase 2 testing too, basically takes a lot of that risk out of the market too. And you can see that when you look at the term structure of the VIX index, which is expected volatility. The 1 month VIX has come down a lot. It's nearly halved now that we've got both of those risks out of the market. But even looking forward, if you look sort of forward to sort of 3 month VIX, you can see the risk of inauguration doesn't seem to be a spike in the green curve. So it looks like the markets are pretty confident that the election day results will hold and we won't have any surprises coming through to inauguration. If we look out further on the curve, you can see it typically does have an upward slope to it just because the future is more likely to have unknowns than the current. But we still have elevated future volatility compared to longer term volatility, which is usually well below 20. So I think the market, although it's comfortable that we've got a vaccine coming, still doesn't know exactly when it's going to happen, exactly how quickly it's going to get widely available and start to get people back to normal. But you can see at all levels, the volatility has come down significantly. So the two events, the vaccine and the election, really have taken a lot of risk out of the market.
And of course, this is also relative to sector performance as well. When we talk about the work from home, work from anywhere stocks to the old economy stocks, as we're looking forward to potentially reopening with a vaccine on the horizon.
Yeah, so we looked at what typically happens around an election a couple of weeks ago, just before the election, and it showed that typically the market's reasonably positive once the uncertainty of an election goes away. And we saw that even in the couple of days before the election, as the sort of polling numbers looked like it was pretty certainly going to be a Biden win. That week, we saw the market rally and we saw some of Biden's policy positions rally, like the clean energy. But what really happened was on Monday, the 9th, when we got the vaccine news as well. And so you can see pretty quickly after that, we've seen a lot of the outperformers so far, which are the blue bars in these two charts, completely reversed. A lot of them fell in the next sort of week and a half after that, while a lot of the underperforming sectors, energy, financials, actually rallied really strongly. And you can basically see the seesaw. The sectors that were the worst affected by COVID had performed the best with the news of the vaccine. The factors that were the worst affected with COVID, whether that's value or small cap, were some of the best outcomes when we got the vaccine. And that's because although people expected the vaccine would work, they didn't know it was going to work as well as it did, and they didn't know it was going to be ready as fast as it is and able to be distributed as quickly as it is. So a lot of people's expectations of when earnings will get back to normal got brought forward, got accelerated, and all of those old economy stocks that have been really hurt by, to your point, the work from home trade or the not work normally trade really rebounded quickly.
And of course, so we have to get through winter because, as you noted, hospitalizations and death rates lag the data that we have right now. And the data that we have right now is quite concerning.
Yeah, so I think we now know that the vaccine's on its way, and we know the election is pretty much done. But what is remaining, and I think not just through the rest of November, but for the next 3 or 4 months until the vaccine starts to get widely distributed, the news will probably be dominated by the coronavirus. And obviously, we have winter coming on. We have a second, or some call it a third wave in the US, which is way bigger in terms of cases than the first wave. It's looking at the moment, obviously deaths happen and hospitalizations happen with a lag, but it's looking like it's at least as bad as the first wave we had in New York City and the East Coast back in April, May. So we sort of expecting to see some bad news coming forward on coronavirus hospitalizations, more deaths, but more importantly for the economy, there's data that we've been talking about that shows that as cases increase, people's spending changes, people's going to restaurants is going to decrease, which means that people that are employed in those businesses are going to be furloughed again. and that's bad for the economy and it's bad for economic data. We haven't seen it in the data yet, but most of the data that's published on how the economy is going is backward looking 2 or 3 weeks, and that's all it takes because the coronavirus has really exploded in the last 2 weeks in America. And so I think in the next 2 weeks to 6, 8 weeks, we're going to see some of the impacts of the new cases in economic data too. And the market might not like that quite so much.
And so we know that shutdowns work. We can see it in the data in our last chart here, but of course you have to weigh that to exactly your point before when you talk about shutting the economy down and what that means longer term with jobs and certain sectors and businesses to remain open. So that's a tough task to weigh out.
Yeah, I mean, the good news is Europe again is about 2 weeks in front of us, and they locked down their businesses and some of their countries a couple of weeks ago, and it's already starting to have an effect. They've stopped the curve from increasing. They're starting to see decreasing new cases, although their death rates, because of the lag, are still starting to pick up. But that's what we want to happen here. So although we're probably going to have bad news coming through the US economy about new shutdowns and new quarantines, I think we've got to your point, look through it a little bit better. If we don't do it, we're going to have an explosion of cases. We're going to have a lot of problems with the hospitals, and we're going to have a pretty sick population. There's lots of data out there that shows we know how to crush the curve. We know how to actually control coronavirus pretty well just by doing sensible things like distancing and mask wearing and avoiding some of the high risk activities. And restaurants and gyms are two of the high risk activities. Anything where there's drinking and eating, masks off indoors, probably best avoided. I know I don't want to say that right before Thanksgiving, but that's just the way that the facts are showing the activities for transmission are. But longer term, if we can get it under control, we can get back to doing things normally faster. And Asia has proved that. And Asia's GDP is much stronger than Europe and America's, and likely to stay that way through winter.
All right, Phil, appreciate your insight. As always, wishing you a happy Thanksgiving. Of course, the Trade Talks audience a happy Thanksgiving as well. Thanks for joining us. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.